They're great opportunities to be had when the market is down.
Well, that's what Trump said this week. It's a great, that's what he tweeted out.
It's a great time
it must
to
be.
buy.
Yeah.
You know, especially if you're a young investor, I mean, this is the best news ever. I mean, this is when you want to start buying. Absolutely. When you have 20 years to invest, 20, 30 years. But also, I mean, now's a great time to do Roth conversions if that was in the cards. Typically, we don't do those until the back half of the year. But absolutely, you want to take advantage of when the market's down. When your IRA is down, you want to move that money to a Roth IRA and experience the recovery in a tax-free account, right? Also, tax loss harvesting. Now's a great time to look at your portfolio and see, are there some moves I can make that before maybe I was a little bit more reticent to make because I had some capital gains? Now that's not so much of a problem.
Yeah.
I think this is a great opportunity to reassess that.
I think that put things in perspective, though, as well. Like if we look at the previous 2 calendar years, so 2023, 2024, over those 2-year period of times, the S&P was up 52%. Right. So we just came off 2 years of phenomenal increase. Obviously, it's not going to continue like that for the next 2 years. And so we've got a bit of a pullback. And there was an intraday. It brought us back to where values were about a year ago. But you're still thinking like this is not such a bad return.
No, not at all. And when you're thinking about what happened in 2008, where market was down almost 57% from tip to tail, 2022 down 24%. But then when you look at the following 12 months after having these drawdowns, I mean, the returns are phenomenal. You've got the S&P up 68% after that low of March 9th of 2009. After what happened in COVID, that short period of time, that drawdown was 34%. The next year, the S&P was up 77%. So this too shall pass. I know that it's tough to hear that when you're going through it, and feelings are valid around this, right? This is unprecedented. It is confusing, but
it is confusing. I'm confused.
Yeah.
I think the White House is confused.
And it's
like, what is the end objective here?
Yes. And trying to predict that or walk through that is completely impossible. So focusing on what we can control. And also the other thing to note is that when we're experiencing these short-term drawdowns, I really encourage you, if you have an Allworth advisor, you have a financial plan. So reach out to them and say, how is this affecting my particular situation? That's really what people are worried about. And what we're seeing is that with this drawdown we're experiencing, and even when we put your plan through a bear market stress test, which we do for our plans, all of your needs are met. For the most part, these kinds of volatility, these events are built into your plan. We don't just run your plan based on rose-colored glasses and you're going to make 6% or 7% year in and year out. We're stress testing them all the time. Your plan is built to withstand these kinds of markets because these kind of markets are inevitable.
Yeah, it's also really interesting this last week, Vicki, not just the stock market, which was volatile, but I think an equally large story is the bond market. And we saw a tremendous sell-off Tuesday and Wednesday. And when people sell bonds, it pushes up the interest rates. So that's actually how interest rates on longer-term bonds are set. It's not government doesn't set it, it's the market. And as people buy more bonds, it pushes down interest rates. And as they sell off the bonds, it pushes up interest rates. It's just your classic supply demand, essentially. But it was remarkable to see how quickly that 10-year Treasury shot up.
Yes. Well, and bonds have been the bright spot in here, whereas in 2022, bonds were going down right along with equities, so they didn't really insulate against risk. But here in this recent volatility, we've seen bonds actually provide some protection. So most investors, especially if you're close to retirement, you're not fully invested in equities. You have quite a bit of bonds in there as well. So when you're looking at the S&P or CNBC and seeing it going down 5% in a day, that's not your experience. It's not what your accounts are doing. That's just what the S&P 500 is doing.
And not only that, most people's bond, the fixed income portion of their portfolio is not in long-term bonds.